I'd like to welcome you all to our afternoon sessions. And our next panel that I'm really excited to introduce is covering a topic that we've talked a lot about on the Planet MicroCap podcast of late. And that's talking about different opportunities in Canada in terms of the non-resource microcap space. And two gentlemen that I've talked to quite a bit now on the podcast are here to actually present on this topic. Their names being Brandon Mackie and Paul Andreola from Small Cap Discoveries. And I want to thank you guys both very much for being here and for your continued support. And for compliance purposes, I'd also like to show this little disclaimer and forward-looking statement. And you can read this at your leisure. I just ask that you not do it during the panel. So with that, I'd like to introduce Mr. Brandon Mackie.
Thank you, Bobby. Good afternoon, everyone. My name is, as Bobby said, Brandon Mackie. I'm going to be the moderator today. First, I'd like to thank Bobby, Shelley, everyone at the Stock News Now crew for having us. It's an honor to be here, and we're really excited. It's been a lot of work to put this together, but we're thrilled to have the panelists here and make this happen. So. Joining me today, I have the editor at Small Cap Discoveries, my partner Paul Andreola, all the way over here on the left. Before we get started, I do want to announce a disclaimer here. So next to Paul is Kristaps Ronka, Director of Brisio Innovations. Paul is CEO, Director, and President of Brisio Innovations, and we're both significant shareholders, as well as shareholders in Atlas, who is here as well. So we just wanted to throw that disclaimer out up front. Okay, with that out of the way, I'd like to go around the table and allow each panelist to introduce themselves. Starting right here on my left, Guy, all yours.
My name is Guy Champagne. I'm the president of Atlas Engineered Products on Vancouver Island, based on Vancouver Island in British Columbia.
Okay. My name is Kristaps Ronka. I'm an investor and an entrepreneur.
And as Brandon said, my name is Paul Andreola. I'm an editor of Small Cap Discoveries. Small Cap Discoveries, if you don't know, is a newsletter. We focus on finding sort of what we call undiscovered microcap companies in Canada.
Great. And just to add a little more background on Small Cap Discoveries and why we're here. Me personally, I'm the lead writer, researcher, chief dishwasher, among many other things at Small Cap Discoveries. We exist to find the best growth companies or opportunities in Canada. That's our mission. And we've been at it since November 2014. Over the years, we've found ideas that have generated attractive returns, which you can see on our website. And we've done that by staying laser focused on microcap companies, often as small as $10, $20 million market cap. Laser focused on Canada and really leveraging opportunities that are unique to the Canadian space. So this could be private-public, IPO transactions, could be innovative technologies that in the U.S. would typically be owned by venture capitalists, but in Canada can be owned in the public domain. Which leads right to the topic of our panel today, which is, wait, there's non-resource companies in Canada looking at the best of the Canadian undiscovered. So yes, we will be discussing Canadian stocks. If you need to leave the room, we ask that you do so right now. I know not everybody is interested, but we truly believe that the Canadian market is one of the most overlooked and exciting markets in the world, and has been for a number of years. And we always encourage people to take a look at the space. Even if you're a U.S. investor. It's been good to us over the years. So, okay, so Paul, to set this up, can you answer for the audience, what is the best performing stock in Canada over the last 10 years?
Okay, a bit of a setup question. Surprisingly, the best performing stock over the last 10 years is a company called Boyd Auto Body. I think we wanted to highlight that a little bit because it goes to show you don't necessarily have to have a disruptive company to be able to get outsized returns. That stock's gone up over 100 times over the course of the last 10 years. And as you'd think, Boyd Auto Body is exactly what it sounds like. It's a organization that basically buys up auto body shops throughout Canada. A lot of people would consider it boring, but their financial performance has been outstanding and justified the more than 100 times return on our initial purchase. That's kind of what we look to do, is find companies that are hyper growing or have that sort of mispricing, mostly because it's a business that people just think isn't going to grow, and surprisingly, a lot of them do. So we're always on the hunt for other, quote-unquote boring businesses that can outperform most other speculative companies.
And we were just at lunch discussing another industry that is made famous by Peter Lynch's book, if any of you have read it, but that's the funeral industry, and there's a lot of interesting dynamics of hypergrowth there and succession planning. So Paul, can you share a little bit of your experience investing in that space? And
yeah, so I was fortunate enough that there were a couple companies back in sort of the 90s in Canada that highlighted to me what an area that would return significant results. And there's a company called Lowen Group in Canada, and one in the U.S. called Service Corp. And similar idea, they literally rolled up funeral homes. And if you understand the succession issues within the private funeral home business, you're finding a lot of companies that they're family owned and run, and when dad or mom wanted to retire from the business, they really had nowhere they could turn to as far as selling. Service Corp and Lowen Group understood this and were buying these assets at 3 or 4 times earnings, and growing their numbers on a per share basis, and ultimately we're getting a 40, 50 times multiple in the public space. So they were able to roll up the industry and do extremely well. The other one back in the 90s that did the same thing did it in the garbage industry, a company called Laidlaw up in Canada. And these both turn into sort of almost 100-bagger plus type results. And you could say both were in very boring industries. So we're not afraid to look for those type of companies. I think we've got a couple, certainly one at the end of the table here that we think fits that kind of criteria. So we're looking for companies that just have solid growth regardless of how exciting the underlying business is.
Great, and that's a great transition for Guy. I'd like to turn it to you. Your company, Atlas, makes wood trusses, what many people would consider a boring business. Yet we know Warren Buffett has famously made billions off of boring businesses. So what got you interested in Atlas, and why do you think the opportunity is anything but boring?
Well, Atlas is a boring business, almost as boring as funeral homes, I think. The interesting thing about Atlas is that there are a couple of tailwinds that we've, I suppose, tried to grab hold of. One is of course, the succession issue in small and medium-sized owner-managed businesses. And the trust business is no different than any others. In Canada, there are over 300 trust companies in an industry that serves an addressable market of about $1 billion a year. And these companies are all owner-managed, generally run $3 to $5 million a year in sales. And many of the owners are approaching retirement age and looking for succession opportunities. Their alternatives are to finance a child who very often isn't interested in following in the parents' footsteps in what is a very boring and not very appealing industry. It's inherently a blue-collar industry, and the children of some of these owners who have done very well for themselves are chasing other career aspirations. Their other alternative is financing a manager who doesn't have the capital to support the transaction that the owner might need to assist them with. So the market really for trust companies is at this stage a buyer's market from my perspective, and we're able to acquire companies that are profitable, stable, have very deep relationships with their customers and in their communities, and draw them into a public company context for a change in multiples for something in the region of the transactions we've completed so far have had multiples of about 1.8. So we're able to buy these companies for at or slightly higher than their tangible asset backing, and draw them into a public structure that has the potential for much more leverage as we look at the multiples that we can attract.
Right. This one's for Paul and Kristaps. You guys, through Brisio Innovations, are currently completing a significant acquisition, purchasing a private company named Silo and bringing it into a public vehicle. Can you give a brief overview of the acquisition and why it fits the criteria?
So name silos in the domain registrar business, similar to the companies like GoDaddy or Two Cows. What we found appealing here was it met that sort of criteria, semi-boring, if you want to call it that. I think everybody knows the domain industry from, sort of late 90s, early 2000s. But we felt we were buying this at a very discounted price to what we think the public markets will give us at some point. But it's similar to, typical private equity type practices. We're finding an asset we think that with some adjustments, some managerial changes, and some polishing, if you want to call it that, should get a higher multiple. And that's really what we try to do. We're not trying to reinvent the wheel. We're not trying to find, the new next disruptive industry. We want to find a business that is solid, profitable, trending in the right way, and we just want to make sure we're buying it for less than we think the market's willing to pay for it. So and that's it. It just fits our model. That's the key thing here.
Mm-hmm. And Kristaps, it's interesting. If you look at Name Silo, it's a company run by two guys essentially. I'm curious from an operational standpoint, what makes this company interesting, and again, how it fits into the criteria.
Yeah, I'm not sure how it fits in the criteria, but my experience is with startups, and I feel like we can bring on a team and run it to that next level and add some services and make it a much more valuable company than it is currently.
So what we find a lot is that a lot of these sort of family-run or owner-operated businesses don't have skill sets that can really grow it outside a certain point. And bringing a team in like Kristaps and his development team, that allows a company that it basically allows it to scale a lot faster and allows it to put into place more professional attributes that allow it to grow even faster. It's really, like I said earlier, it's polishing, but you're taking an existing business that's actually doing quite well and just adding a little bit more fuel to the fire. And that's what we have here.
And Paul, just to follow up, it seems like a big part of your strategy and a big theme over the last few years has been taking private companies and bringing them public. Many times, at $10, $15 million IPO valuations that you typically wouldn't see in the U.S. I'm curious why the strategy and why you think that Canada offers a unique opportunity to pursue it.
I've been at this business for about 20 years, and what I've really come to notice is that in Canada, there really isn't a sort of a true venture capital market, or it's at least not as mature as it is in the U.S. So a lot of companies, startups or small companies, have very limited places they can go to as far as getting funding or to be able to find an exit. So the Canadian MicroCap market serves sort of as a junior venture capital market that you see down in the U.S. I think the Canadian exchanges are a lot more robust and more conducive to helping these smaller companies. And then I think just because Canada is sort of shadowed by the U.S., I think there's a lot more mispricing in the Canadian market because everybody tends to gravitate to the U.S. thinking that's where the opportunities are, that's where the sexy businesses are. It really allows this sort of gaping opportunity for I think savvy investors to be able to take advantage of the mispricing you get because of all these dynamics at play. And then the other thing I'd say is that, and it's happening to some degree in the U.S. as well, but the nature of the brokerage industry or the analyst research industry is such that they're going up the food chain, so into bigger companies. The smaller companies are left more undiscovered, and there's fewer players that are actually in that sector. So again, back to the mispricing. I just think the opportunities for sort of solid, profitable, and not necessarily profitable, but good, solid companies in Canada are better. There's just less players chasing that market.
And Guy, if we could turn this back to Atlas for a moment. You were involved with the company for many years as it was private, and it recently came public last year. What was the rationale for taking Atlas public, and how has the company benefited from the growth strategy?
Well, the rationale for taking it public was that Atlas was a company that we spent a number of years tuning up to a pretty remarkable level of operational and financial performance. Notwithstanding the fact that it's a small company in its own right, but looking at the truss industry landscape across Canada, it very clearly became what is from a comparable perspective, a very solid benchmark that other companies could be driven to grow to in terms of results. The opportunity to take it public was to take advantage of this tailwind in the succession or the exit planning scenarios that these owner managers were facing. But it also, we also saw a tailwind in another arena, and that's a change that's occurring in the construction industry, in the sense that trusses and the companies that were manufacturing and selling trusses in Canada basically just sold trusses and I-joists and joists for single-family dwellings, multi-story apartment blocks, and that's where it ended. Many of these trust companies, being owner-managed, really didn't have the impetus to take the next step and invest in their businesses beyond where they were at. They were content with the living that they were making. They were, in many cases, in terms of the companies that we've been looking at, have been turning away sales. They certainly weren't working at optimal levels, but nevertheless, the owners of those businesses were earning an income that they were satisfied with. So, at their stage in life, they weren't going to make the investment that they needed to make to keep up with the shifts that are underway in the construction industry. They wanted to leave that to the next guy to make. So we decided to pursue an acquisition strategy because we wanted to capture relationships with clients and leverage those into improved performance for the companies that we're acquiring, that at scale offer significant potential. I mean, they say that scale gets turbocharged when you add a network effect, and there's a lot of truth to that. So, in the context of Atlas, for example, by adding a number of entities, we're able to procure raw material at scale, which significantly adds to the bottom line. We're able to redeploy talent at scale, which again significantly adds to the bottom line. So by aggregating these businesses, we're able to become a low-cost competitor to others in the field that aren't necessarily able to do that. So, from an economics perspective, it made a whole lot of sense for us to pursue that. The other aspect is the fact that we're able to acquire these companies for basically a song, and build something that, as a result of us being a public company, the sellers are motivated to support us as we move forward. So, the people who sell us their businesses have a vested interest in our success and help us achieve that success as well. So there are a whole bunch of things that we're able to harness in this model, not unlike what Boyd did. So we saw it as a very interesting opportunity to pursue.
Great. I'm curious, and anyone can take a stab at this, is when you bring a private company into the public domain, from a cultural standpoint, what changes? And as the company grows and maybe external hires are made, how do you keep the core entrepreneurial spirit of the existing private company as it grows and expands, in your experience?
Well, I can answer from a little bit from the outside. I think there's a higher degree of professionalism that has to be put in place with a public company. Of course, every year the company has to get audited, so systems have to be put in place to be able to handle that. I think the other thing that starts to happen is there typically is a re-energization of the employees and management, because now there's a little bit more visible sort of result with the share price. And yeah, so a lot of systems get reaffected. Culturally, you see some invigoration with a lot of people. Sometimes there's a bit of a backlash because things were pretty comfortable, and you know, changes aren't. Not everybody reacts to change as well, but you know, it's generally been very positive, and we sort of liken it from taking it, you know, the mom and pop type of company, and turning it into a company that can actually chase, you know, a world-class opportunities. So you know, a lot of those changes
yeah,
are necessary.
what we've experienced is, you know, at Atlas, I talked about the tuning of the core company that we undertook for a number of years, and the people that did the heavy lifting over the course of that period were people in the trenches. And as we move out and integrate the companies that we're acquiring, the people that did the heavy lifting at Atlas are able to come alongside the acquired company's staff as colleagues, and show them as colleagues how they can tune up their operation or how they can improve their operation. So you know, the notion of you know, consolidation in a larger corporation acquiring smaller companies can be quite intimidating to the local entity, but if they have colleagues coming alongside them to help them improve their lot, it's very, very effective. The other factor that's been quite interesting and a bit of a surprise is that you know, in two of the cases, the owners of the companies who have sold to us have left. They've retired happily, and the people who have been left behind find new life breathed into them. You know, they have a new lease on life. They can finally do the things with their business that they've been thinking the former owner should have been doing a long time ago. And it's pretty basic stuff. You know, in one case, they weren't following up on quotes. It's just ridiculously simple stuff. And really all that's necessary is that they be given the freedom to take those steps within the context that we present to them. The other factor is that you know, the managers of these entities now have career opportunities, and they also have stock options potentially, and they participate in bonus programs, and they can be part owners of the company, and it's a tremendous driver of productivity and performance that pays off in spades.
Great. And just on the flip side, again, anyone can take a stab at this. Where do companies, you know, whether it be investors or operators, go wrong when a private company is brought into the public domain? Any war stories or lessons learned from?
Oh yeah, yeah. I think you know, usually where we see mistakes or issues is where management don't really understand what their strengths and weaknesses are, and also believe that the success of the share price is reflective on how well the business is doing, and a lot of times that's not the case. So we've seen that. We've seen it where management think everything's fine because the stock price is up, but the business isn't being run optimally. So you know, management are always key, especially with small companies, and even more so if they're making, you know, mistakes. So that's something we try to, you know, look at very deeply and try to correct as soon as we can.
Guy, this one is for you. You really have an interesting acquisition strategy with Atlas, and it's not unlike, you know, Warren Buffett, who's found success convincing owner-operators that you're the, you know, the partner of choice when it comes time for succession. But I imagine there's challenges, you know, with the emotional attachment to the business, and especially with your negotiating price. What strategies have you found useful in convincing these owner-operators that you guys are the right partner, and how has that grown over time as you've had a couple successful ones under your belt?
You know, it was really interesting. At the outset, we came to trade November 9th, I think it was, in last year. So we've been a public company for just a few months. And when the announcement was made, we started attending industry events, trust association meetings, very boring meetings for a very boring industry. And we started making cold calls and introducing the concept to trust company owner managers. And you know, there was a lot of skepticism, and few people understood really what we were setting out to do. The tables have turned somewhat. I mean, when I first presented the idea to the investment community, our thought was that we would be able to acquire businesses to get us to a $50 million run rate over the next 3 years. The efforts of our door knocking and now what's occurred is people are offering themselves up to us as a succession vehicle. We're likely going to achieve that result within 1 year, because that's how many companies we have in our pipeline. So the stage in life that the owners are at is such that they need to do something about retirement, and the best vehicle available to them, other than the owners that have sold to us, who are money under the mattress types, took their money and they've invested it. But those who have an interest in maximizing their return leave a portion of it, and we've got all kinds of different scenarios that we're tinkering with that makes the prospect of earning more than bank returns quite attractive. It makes the prospect of them continuing to participate in the development of their business in vicariously attractive as well. So we come along and we say, it's yours, it continues to be yours, and they cheer us on. So culturally, it's been very beneficial. Now, we haven't done hundreds of acquisitions. We're looking at 9 at the moment, but the support and the enthusiasm for being part of this bigger picture has been remarkable.
Great. One of the clear benefits when a company comes public is access to more capital and resources to pursue growth. As one of the main drivers why many companies go that route. Kristaps, I'm curious, what are your growth plans for NameSilo?
Yeah, so using the public markets, we plan to, I don't know how much we want to talk about, but acquire other companies that are in the same space and grow similarly to Guy.
Back to sort of what I said earlier about, some of the advantages of being public are capital for sure, but instituting better practices than what the founders had done, and in some cases by no fault of their own. But NameSilo is an example where they do no marketing right now, zero, and they're able to grow at about 75-80% a year. Kristaps' background is marketing, so even a little bit of marketing to an entity that's never done it before should have an impact. And then having fresh eyes coming to a business like this, you find other things that you can do to tweak it and ideally make it better. So part of that comes from being public. Part of it comes from a new fresh set of eyes. Part of it does come from shareholder base that is able to have some influence over how the business is run. But I think in general that's that opportunity is one that I don't think investors should take too lightly. There's a tremendous, in my opinion, opportunity where a lot of these private companies have no exit strategy or very limited exit opportunities or sale opportunities. And I think it would do a lot of investors and some of these exchanges to really address that instead of always waiting for companies that are desperately in need of money just to sort of create their business. There's a lot of entities out there that are great businesses that are just looking for some form of exit. And if you can bring on some new fresh set of eyes, new management team, it's amazing the returns you can get both operationally and I think value-wise. So I really think it's an effort that a lot of small-cap investors or micro-cap investors should take on to sort of lessen your risk by investing in businesses that have already a substantial track record, but now are, there's something new added to it, whether it's a new management team or new, new sort of systems in place.
Right. Now, Paul, if we could take a step back for a moment into how you would even discover companies like Atlas or NameSilo. You've had the fortune of finding a few hundred-baggers over the years, and so I'd like to talk a bit about your signature discovery process. How did you develop the process, and how have you used it to find companies like these over the years? Yeah,
I mean, a lot of it was trial and error, and a lot of it is also just learning as much as I could from others and books. But I mean, part of our criteria is that we're looking for companies that have some form of growth or hyper growth. So in the Canadian market, what we do, we literally sift through every single CDR filing in Canada, so which CDR is the equivalent of Edgar down in the US. And we do it manually, so we're looking for certain criteria that will sort of flag a company, and then we'll go and look deeper into it, and then there's other criteria we look for, such as profitability and ideally margin expansion, share structure, things like that that just add to what we think are increase the odds of success. And then what we were noticing is that we were almost running out of ideas in the Canadian marketplace, and we said, well, okay, this applies to the private market as well. There's no reason why we can't go find companies that fit this criteria in the private space and then try to help them go public. So we've done that now for it's 3 companies that we've done over the last couple of years, and there's a few others that we're ideally looking to see if we can't take them public as well. But the added benefit there is you get this, there's an arbitrage really, where in the private domain you might get 5 times earnings as a valuation, whereas in the public market you get 15 times. So as long as there's enough scale, just taking a public sees a dramatic lift in valuation. Add in the fact that these companies are already profitable and growing, and it's amazing the kind of lift you can get on these opportunities. So we apply the same sort of search criteria. It's just we look everywhere, including outside the public markets.
So really just a couple more questions here, and one in particular to bring this all together, the Canadian market and why we think it's such a great opportunity. I was reading a Bloomberg article recently that called the Toronto Venture Exchange the cheapest stock market in the world, and it's had the worst performance, I believe, year to date. Second only behind Venezuela. It's pretty incredible when you think about it. And so I'm curious, Paul, if you have any insights. How does that happen? And
I think everybody outside of Canada, predominantly thinks of Canada as a resource-based, country, and I mean to a large degree it is. But the sort of the focus, because there's so many resource companies, I think the focus within the research industry is built around that. So you got a lot more expertise in extraction type businesses, and less so in sort of non-traditional resource businesses. We've got a little bit of a saying where we say, we don't like to buy assets when there's blood in the streets. We like to buy when there's nobody in the streets. And I think that's part of what happens in the Canadian market is it is predominantly resource, so it's going to get influenced by the commodity prices that drive those resources. But the other industries within there's not a high degree of expertise to be able to properly value these vis-a-vis the rest of the world. And the rest of the world is unlikely to want to operate in a small market like Canada. So it's just too many opportunities. So the market is influenced by things like resource prices and the sort of structural decomposition of the industry, or the investment industry, and it allows for, I think, fantastic opportunities.
Yeah, and just to follow up on that, I mean, you would think that at some point, if there were these attractive, non-resource opportunities and a couple big winners, that eventually people would flood in and sort of course correct that valuation issue. Have you observed that over the years? And if not, what do you think some of the barriers are to value discovery?
Absolutely. A lot of the companies that get bought up in Canada get bought by international companies. TO Networks was a good example of another great little company in Canada that got bought out by PayPal. That happens all the time. We're seeing those sort of deals get cherry-picked by international companies. That should, over time, self-correct. The other thing I got to remind people is in the microcap space, if you get really good at a microcap and as a microcap investor, you tend to graduate out of the microcap space. So I think that's even more so in Canada. If you get really good as a microcap investor, you move to the US and become a microcap investor there. So the opportunities just keep sort of redeveloping themselves in Canada. Great.
So we've got about 10 minutes left. At this point, I would like to open it up to Q&A from the audience. And yes, sir. Yeah. And I'll just repeat that quickly. So the question was on management incentives and preferred structures to, for desirable results. Okay.
Yeah, I mean, I'll start. Obviously, we like to see management with a significant stake in the shares. Significant percentage of shares outstanding. And then really, you don't want to see a high salary in a microcap company. You want the results to be driven by what all other shareholders ultimately want to see, and that's the business is being run to create shareholder value and increase in share price. I mean, those are the key things. And then you just have to do a little bit of a history check to see how management treat their shares. If they issue a lot of options every time a stock is down, that's a bit of a red flag. If they issue options at a price above market, that's another thing to keep note of. It's really, there is the ability to sort of see historically how management treats shares, and I think that's the easiest way to affect or to realize if somebody's aligned with shareholders.
I think the other side of that, from an operational perspective, is you want to drive you want to incentivize the behaviors you want to drive, and the objectives of the company along the lines of becoming a great company and continuing to drive significant profitability cause you to design incentive schemes and option grants that align with that philosophy.
All the way in the back. The question was if the price discovery of Canadian companies is due to uplisting on exchanges, if it's due to institutional support, if it's due to M&A activity. What's the driver behind closing the valuation gap, so to speak? Is that okay?
Yeah. So one of the things I've really noticed is that there's an easy threshold to see. Typically in Canada, being a smaller market, a $50 million market cap or $100 million market cap, once it gets to that level, the institutions are actually able to do something with it. So if you get a company that's worked in obscurity and then starting to grow and get that kind of market cap, absolutely. It's almost there's a shortage of companies that actually meet that qualification in Canada, and there's an abundance of small cap managers that are looking for these deals. So once it gets across that goal line, you tend to see more than one start to rush to try to pick it up because there's such a limited amount. And then M&A, I mean, just the sheer numbers. If you can find a company that's trading at multiples significantly lower than what the industry is paying anywhere else in the world, it's going to become a target, and that happens on a regular basis. Yeah.
The question was, is there ever an activist component to your business model? And it would be interesting to hear from the investor side and the operational side.
Yes, the answer is yes. I mean, we tend to be getting bigger positions in companies, so we are always concerned with how management are going to affect the shareholder, our shareholder value. So where we can, we try to be as active as possible. We've yet to get to a position where we try to reconstitute a board or do anything that way, but we tend to have an influence because now we tend to have a little bit more stock than the average investor. So that's, we try to avoid it. We try to buy companies that don't need any of that, but that's not always the case.
I'm curious if you have any perspective on the management side. Is it something that keeps you up at night? Do you have any experience with that?
No experience with that so far.
It's a good thing.
I think as a manager, the key again is to focus on building a great company, and that tends to keep everyone's interests aligned.
Well said. Yes, sir. So the question was, when you buy a private company, where does the capital come from? So source of funds.
So in our case, every transaction is different, and being in acquisition mode, we're inherently opportunistic. But in reality, I'll describe two of the transactions that we engaged in, and in both cases, we used bank financing because we were able to make the acquisitions for 1.8 times EBITDA in both cases. And we actually got these assets for at or near their tangible asset backing. So the banks are more than willing to lend against hard assets. We won't buy an unprofitable business. So the EBITDA margin of both companies that we looked at were between 15 and 20%. That makes it very easy to finance. Now, that's fine in terms of what we're doing now. We're aggregating a number of small companies and growing the free cash flow that these entities are generating. But what's occurring in our industry is that we're emerging as a company that's gaining a lot of attention, and we have a bit of a first mover advantage, I think, that we want to retain. So invariably, some of the next steps will be to acquire much larger companies than we have been to date, and that'll require a capital raise. But for the smaller ones, we're generally able to do it with bank financing and potentially convertible debt. But
yeah. Real quick, the question was, why would whether Guy, Paul, focus on buying only profitable companies when the IPO, for many cases, is to take just an idea or an unprofitable business who needs help funding and growing the enterprise? Why only profitable? Aren't those the ones that don't need to go public?
Yeah,
I guess
I'm dying to answer that question. Absolutely, it's a criteria issue for us. We've been successful enough only buying profitable companies or near profitable companies that, regardless of what the upside looks like, we tend not to get involved in companies that are either just a product or they haven't got the sort of the track record of success. The returns you can get on finding these undiscovered little companies that are proven themselves to some degree, and then just adding a little bit more to it, it's 100 times your money sometimes. It's the kind of returns that people are expecting to get with these wild speculations. If you saw it and experienced it, you'd never go back, and that's what we've done. Yeah.
I'll take a stab at that as well. In our case, it's a very boring industry. As you know, we're buying very profitable companies, but what the industry is waiting for because of market forces what's emerging is the potential for a disruptive business model. So if you think about all these trust companies that sell a pretty mundane product to builders that they serve, the building industry is shifting, and all of these companies who have an ironclad grip on their customer bases are going to encounter demand from their customers to supply them with other kinds of components. So the traditional builder can shorten their cash cycle dramatically by assembling components like prefabricated floors and prefabricated walls rather than stick framing everything. And I'm getting into the details of the business, but what that means to them is that they're going to be able to access their construction loans 35% more quickly than they would otherwise. And by having prefabricated components, they're going to reduce their costs by up to 25%. So there's a big incentive in the construction field that's driving companies like the ones that we're buying to fulfill a need. But within the context of our industry, the owner-managers are reluctant to take that step and invest in the thought processes and the systems that they have to bring those products to market. So there's a disruptive business model emerging in an industry that's old-fashioned. And if you look at the individual businesses, what we have are very, very sophisticated manufacturing processes. Everything is they've got computer-controlled saws and computer-controlled laser guns that project the image of the truss onto big tables. But the management processes are archaic. So you know, it's an industry that's waiting for a significant change, not unlike a lot of technology companies.
Yeah, Sam, the question was, so what do you do when you're wrong and the liquidity isn't there, you realize that the opportunity isn't what you thought it was? What's plan B?
You curl up in the fetal position and find a bartender. You try to mitigate it as much as you can, and if you can't fix it, you know, you got to go into this business understanding you're going to get some wrong. It's just nature of the business, and just don't make a bet that'll wipe you out. So, yeah, just be careful.
Okay. Well, thank you so much, everybody. Thank you to the panelists. Thank you for coming. We really appreciate it.